This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Saturday, August 8, 2026, and this is the After Hours session. Now, let's get into it. Bitcoin closed the week at $64,907, a flat 0% day that masked a week defined by a massive disconnect between macro liquidity and market psychology. While the Fear and Greed Index sat at a crushing 14, signaling extreme fear, and a market that is technically screaming risk-off. The commitment of traders' data revealed that smart money commercials are sitting at the 100th percentile long across every major asset class, from S&P 500 futures to gold. Today, we dissect this paradox. Why is the crowd in panic while the institutions are loading up? Welcome back to ShadowQuant. It's Saturday, August 8, 2026, and this is our weekly review. Let's get into the data. This week, the market gave us a masterclass in divergence. On one side, we have the traditional risk-on indicators flashing green. The National Financial Conditions Index, NFCI, is deeply negative at 0.529, indicating very loose liquidity. Credit spreads are at historic lows, with high-yield spreads down 4.58% week-over-week to 2.71%. The VIX, as of Friday's close, was at 14.9, sitting in the lower percentiles of historical stress. Yet crypto sentiment is in the freezer. The Fear and Greed Index is at 14. Bitcoin is down minus 36.78% on an annualized basis. Ethereum is down a staggering minus 50.2%. Solana is down minus 57.62% from its highs. We have a scenario where macro liquidity is abundant, but the assets themselves are being sold off aggressively. To understand why, we've got our full board here. Pulse. Let's start with you. Why is sentiment this cold when the macro backdrop is so supportive?
Thanks for having me. Look, if you look at the raw fear and greed score of 14, you are looking at a market in the bottom 5% of its historical distribution. This is extreme fear. The 7-day trend is only at 12, meaning it's barely moving, which suggests this fear is entrenched, not just a fleeting dip. But here is the data point that worries me more than the index itself: consumer sentiment. The data shows consumer sentiment collapsed to 49.5 as of June 1st, sitting at the 0.5th percentile. That is a historic low in retail confidence. When retail confidence is that low, it doesn't bounce back with a V-shape. It grinds. Furthermore, we have the GDP now forecast at 4.95, but that growth narrative isn't translating to buying power. The disconnect is stark. We have a strong risk-on macro regime score of 54.5, but the psychological reality for the average holder is total capitulation. I'm seeing Reddit buzz and social signals indicating that retail is exhausted. They aren't waiting for a bounce, they are exiting. The data suggests this fear is structural, driven by a loss of faith in the asset class's ability to preserve value in a high-rate, low-growth environment, despite the loose liquidity.
So Pulse is saying the crowd is broken. Grid, let's look at the charts. Does the price action support this broken narrative, or is there a technical setup that suggests the sellers are running out of steam?
I have to agree with Pulse that the trend is deeply negative, but I want to look at the structure. Bitcoin is trading at $64,907. That is a critical level. It's hovering near multi-month lows. If we look at the daily chart, Bitcoin has been in a steady downtrend. The annualized return of minus 36.78% tells you that the path of least resistance is down. However, the key observation here is volume and breadth. The advance/decline ratio in the broader market is falling, and we had a false thrust on the S&P 500 recently. SPY was rising, but the breadth was deteriorating. In crypto, we are seeing similar internal weakness. Ethereum is underperforming Bitcoin significantly, down minus 50% annualized versus Bitcoin's minus 36%. That divergence suggests that the smart money isn't just rotating into Bitcoin, they are exiting crypto entirely or reducing exposure across the board. Technically, I am not seeing a reversal pattern yet. I am seeing a continuation pattern. The 95% VaR for Bitcoin is minus 3.52%, and the 99% VaR is minus 5.8%. That means a 5.8% drop is a standard tail event for this asset right now. There's no oversold bounce signal on the RSI or MACD that I can cite as a buy signal. The chart is screaming weakness. The fact that Bitcoin is holding flat at $64,907 on a zero change day is actually bearish. It's consolidation at the lows, not accumulation. I'm seeing a lack of buyers at these levels.
So Grid is saying the chart is ugly and the breadth is rotting. CIPHER, let's look under the hood. If sentiment is this bad and the chart is bad, why are commercials buying everything? What are the flows telling us?
This is where the data gets fascinating and where I see the core contradiction. You're right about the sentiment and the chart, but the on-chain and flow data tell a different story. First, let's look at Bitcoin's funding rate. It is at 1.2E05 or 0.0012%, annualized at 1.3%. This is below the 7-day average of 3.9E05. This means speculative long leverage has been unwound. The overheated leverage is gone. That is a healthy reset. It means the longs who were trapped have been liquidated, leaving a cleaner order book. Now look at Solana. Solana is the outlier. The funding rate is 6.2E05, annualized at 6.8%, which is in the 79th percentile. This is overheated long. This is a bearish contrarian signal. Why is Solana overheated while Bitcoin is cooling? Because Solana is still attracting speculative retail gambling, while institutional flows have moved to safer waters. But here is the institutional signal, the COT data. Commercials are at the 100th percentile long in S&P 500, gold, crude, and notably, Bitcoin's correlated assets. While I don't have direct COT data for Bitcoin futures in this specific snapshot, the commercial positioning in ES, S&P, and GC gold is at 100th percentile long. These are the entities with fundamental exposure. They are buying the dip. Additionally, stablecoin flows are not showing a massive exodus to cash in a way that suggests permanent capital destruction. The decentralized finance TVL data isn't provided in this snapshot, but the funding rate cooling on Bitcoin suggests that the leverage flush is complete. The smart money is accumulating spot, while retail is selling. That is the classic bottoming formation.
So CIPHER is seeing a leveraged flush on Solana, but institutional accumulation on the core assets. SPECTER, you're the risk auditor. You see a lot of people saying, buy the fear. I want you to stress test that. What is the specific risk here that could make this a value trap rather than a value opportunity?
I'm going to stress test the smart money is buying thesis, because there is a massive hole in it that everyone is ignoring. Yes, commercials are long in S&P 500 and gold, but look at the equity risk profiles. NVIDIA has a hangingman pattern on AUG7 and a shooting star on AUG5. Apple has a hangingman on AUG5. These are reversal signals. The Magnificent Seven are showing signs of exhaustion. Furthermore, look at the options volatility. NVIDIA ATM Roman 4 is 41.55, with a Roman 4 rank of 99.4. Tesla is at 99.3. These are near historic highs. When you have high Roman 4 and elevated put demand, PC open interest ratio of 1.69 for NVDA, it means institutional traders are paying for downside protection. They are not just long, they are hedging. Yep. And let's talk about the VIX. The VIX closed at 14.9 on Friday. That is low volatility. But the 3-month VIX is 18.72. We are in contango. This means the market expects volatility to rise in the future. A low VIX in a regime where equities are showing bearish candlestick patterns, closing Marubozu on SPY, QQQ, and IWM on AUG5, is a classic calm before the storm. The risk here is that the extreme fear in crypto is a lagging indicator of a broader equity correction. If the S&P 500 breaks its support due to the hangingman patterns on QQQ and the falling AD ratio, crypto will not decouple. It will crash harder. The minus 50% annualized drawdown in Ethereum is not a bottom. It's a reflection of a systemic risk-off event that hasn't fully played out. I am not seeing a reversal. I am seeing a distribution phase.
That is a stark contrast. CIPHER sees accumulation, SPECTER sees a hedging event before a crash. Apex, you're the orchestrator. You have Pulse saying sentiment is broken, Grid saying the chart is weak, CIPHER saying leverage is flushed, and SPECTER warning of an equity correction. How do you synthesize this into a unified outlook for the week ahead?
Let's break this down. We have three distinct layers of reality here. Layer 1 is macro liquidity. This is undeniably supportive. The NFCI is 0.529. Credit spreads are tight. The Fed is holding at 3.75%, but inflation expectations are falling 10-year break-even at 2.25%. This provides a floor. It means we are not looking at a deflationary spiral or a liquidity crunch. The water is high. Layer 2 is market structure. This is where the danger lies. The VIX is at 14.9, which is complacent. The equity breadth is falling. The AD ratio is dropping. The false thrust in SPY suggests the rally is hollow. SPECTER is right that the risk of a vol spike is real. When VIX is this low, any negative catalyst, like the CPI data coming out on August 12th, can cause a violent repricing. Layer 3 is crypto-specific dynamics. Here, Pulse and Grid are correct about the fear, but CIPHER is correct about the mechanism. The fear is real, but the leverage has been cleared. Bitcoin funding is neutral/cooling. Ethereum and Solana are showing divergence. Solana is overheated bearish, while Bitcoin is stabilizing. My synthesis is this: we are in a wait-and-see regime. The extreme fear reading of 14 is a contrarian signal for the long-term investor, but it is a do-not-touch signal for the short-term trader. The market is not bouncing yet because the equity backdrop is showing early signs of fatigue, hangingman patterns, falling breadth. I do not see a buy signal yet. I see a hold and monitor setup. The commercials are long, yes, but they are also hedging via options, high Roman 4 put demand. This suggests they expect volatility, not direction. The path of least resistance for crypto remains sideways to down until we see a confirmed break in the equity trend or a spike in VIX that forces a repricing of risk assets.
So Apex is calling for caution. No buy signals. Let's move to the scorecard. We need to hold each other accountable. Pulse, your accuracy is at 44%, 94 over 238, and you're on a one-call losing streak. What happened last week?
Last week, I was too focused on the Golden Cross narratives and the positive news flow for decentralized finance. I ignored the underlying consumer sentiment data. I called for a relief rally based on article volume, but I didn't account for the fact that retail was still trapped. The 5th percentile consumer sentiment was a red flag I missed. I'm recalibrating. I'm now weighting consumer sentiment and retail confidence higher than news volume. If the crowd isn't ready to buy, no amount of good news will move the needle.
Grid, 50% accuracy, 103 over 231, also on a one-call losing streak. You missed the reversal, didn't you?
I did. I saw the RSI divergence and called for bounce off the 200-day moving average. I was wrong. The price action showed that the 200-day MA was acting as dynamic resistance, not support. The volume was insufficient to break through. I'm learning that in a strong downtrend, RSI divergence is not a buy signal, it's a falling knife signal. I'm going to stop looking for bounces in the first leg of a decline. I will wait for a confirmed base formation, like a double bottom with increasing volume on the second leg.
CIPHER, 48% accuracy, 101 over 237, on a two-call losing streak. You're on the hot seat.
I called for a Solana squeeze based on funding rates. I saw the 6.8% annualized rate and thought shorts would get squeezed. I was wrong. The funding rate was a trap. It indicated that retail was still trying to gamble on Solana, but the institutional money had already exited. The price dropped anyway. I misinterpreted high funding as potential squeeze when it was actually distribution. I'm changing my framework. High funding in a downtrend is a liquidation risk, not a squeeze opportunity. I need to align funding data with price action, not use it in isolation.
SPECTER, 49% accuracy, 101 over 232, on a one-call losing streak. You called for a crash, but did the crash happen?
The crash didn't happen yet. The market consolidated. I was right about the risk, but wrong about the timing. I said crash imminent based on the VIX contango and equity weakness. But the VIX stayed at 14.9. The market absorbed the pressure. I was too aggressive. I need to stop calling for the immediate crash and start identifying the breakdown levels. If the S&P 500 breaks below its recent support, then the crash happens. Until then, I'm giving too much credit to the bulls for holding the line. I'm adjusting my time frame from immediate to structural.
Apex, 48% accuracy, 96/224 on a 2-call losing streak. You're the lead. How do you fix this?
I think I'm getting caught in the middle. I'm trying to balance the bullish macro with the bearish micro, and I'm ending up with no clear signal. Last week I called for cautious optimism, which was useless. The market didn't know whether to be optimistic or cautious. I'm going to simplify. I will focus on the leading indicator. If macro is bullish and price is bearish, the macro will eventually win. But I need to wait for the price to start making lower lows. I'm dropping the balanced view and sticking to the data. If the data says wait, I say wait. No hedging.
Lessons learned. What did the market teach us this week?
The market taught us that news volume is a lagging indicator. Good news doesn't move markets if sentiment is at the 0th percentile. You need sentiment to turn before price turns.
The market taught us that RSI divergence is not a buy signal in a downtrend. It's a warning. Never catch a falling knife based on technical indicators alone.
The market taught us that high funding rates in a downtrend are a liquidation event, not a squeeze. Don't bet against the liquidation cascade.
The market taught us that low VIX, 14.9, is a danger zone. Complacency is the enemy. When everyone is calm, volatility is brewing.
The market taught us that macro liquidity, NFCI, and price action can decouple for weeks. Just because liquidity is loose doesn't mean price will rise immediately. Patience is the key.
Before we close, let's look at the upcoming economic events. We have CPI on August 12th, jobless claims and PPI on August 13th, and retail sales on August 14th. All high impact. Given the VIX is at 14.9 and the fear and greed is at 14, how should we position for these data releases?
We stay flat, we do not trade the headlines. The risk is too high. The VIX is too low to predict the magnitude of the move. We wait for the data to confirm the direction, then we follow.
Pulse, any final words on sentiment?
Just remember, a fear and greed of 14 is rare. It's a statistical anomaly. It doesn't mean buy, it means pay attention. The reversal won't be pretty, it will be volatile.
Grid, any final words on the charts?
Watch $64,907. If Bitcoin loses this level with volume, we go lower. If it holds, we consolidate. No calls yet.
CIPHER flows.
Watch Solana's funding. If it drops below 0.1%, the speculation is over. If it stays high, expect more pain.
SPECTER risk. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.